Nelson, distinguished guests, ladies and gentlemen, good morning. It's my pleasure to speak to you today at today's conference of the Hong Kong Investment Funds Association. The theme, as Nelson has introduced, is RE. It's probably the world's shortest theme, and I like it. With this in mind, I'm going to title my speech on 3 RE words, which are not what you've seen shown on stage. It's reflect, reset, refocus, the game plan for Hong Kong's asset management hub. Let's start with reflections in 2022. The investing landscape saw a tectonic shift last year, and asset managers now operate in a profoundly different environment from that of the past 2 decades. Markets were shaken by abrupt end to the zero interest rates and quantitative easing, and this was compounded by the lingering impact of pandemic. In many developed economies, commodities prices and supply bottlenecks drove up inflation, and to tame it, interest rates had to soar. Add to these a war in Europe, lockdowns in China, and continuing geopolitical tensions. Through most of 2022, market players operated in uncharted territory. Both equities and fixed income were hit hard, and valuations were sent lower for most public fund portfolios. Equities lost 20% in value and saw the worst year since 2008. Bond indexes also record double-digit losses. A typical investor, long in both fixed income and equities, would suffer regardless of their allocation. Our MPF painted a similar picture. The NAV of constituent funds fell more than 10% last year, according to data from MPFA. Despite the perfect storm last year, Hong Kong has shown resilience and seemed to have turned the corner late last year. Let me share a few encouraging signs for the asset management industry from the first quarter of 2023. Firstly, our sample of more than 400 corporations with Type 9 license, asset management income for the first quarter was flat year on year. This was a clear improvement from the double-digit declines through all quarters of 2022. Secondly, the NAV of Hong Kong domicile funds has resumed growth from the bottom of third quarter of last year. NAV has rebounded for 2 straight quarters to $175 billion. Also, our fund flow data show inflows into Hong Kong domicile funds for 2 straight quarters, totaling $7.5 billion, after a mild outflow in the third quarter of last year. This is an important gauge of investor sentiment. Thirdly, retail fund sales in Hong Kong have put an end to 5 quarters of net redemption to return to positive territory. That's based on your own IFA data. It was as if the reset button was pressed for Hong Kong in early 2023, when the city's last COVID restrictions were shed and mainland reopened its borders. We saw strong inflows into money market funds, short duration bonds, balance funds, and mandates from insurance companies, especially for those financial institutions with large retail networks. But the investing terrain is still rough. Performance varies because it depends on the resilience of one's business strategies and portfolios against rate hikes and other headwinds. Asset managers have to navigate a real economy where high interest rates constrain credit expansion. The landscape only gets more complicated with US debt ceiling, which was supposedly resolved, and regional bank concerns and tensions between the largest economies. However, we must not lose sight of the many opportunities driving innovation and sustainable investment, and these include digitalization, Web3, generative AI, and China's reopening. Back when the cost of money was zero or near zero, a rising tide lifted all boats without calling for an active strategy, and you score regardless. When you are up against strong headwinds, as you were last year, playing defense is the only strategy. So far this year, the market is still fraught with uncertainty, but is showing good value at the same time. So there's a need to refocus strategies to balance defense and offense. Moreover, with US Fed fund rates hovering above 5%, a clear strategy is essential to navigate the complex landscape, manage the risk, and harness emerging opportunities. The SFC, as a financial regulator, also needs a very clear strategy to navigate the landscape and bring Hong Kong to the next level as a global asset management and private wealth center. Our strategy comprises 4 prongs, namely onshoring, platforms, products, technology, and services. The first prong of our game plan is the onshoring of investment funds. This is to develop Hong Kong as an asset management hub, as the city's biggest value proposition is in portfolio construction and management. Our efforts are bearing fruits. Over the past 3 years, the number of Hong Kong domicile funds has increased 20% to more than 900. They now account for nearly 40% of all authorized funds. In the same period, more than 3/4 of the new funds were Hong Kong domiciled. To promote onshoring, Hong Kong has introduced 2 new fund structures as alternatives to trust fund. The measures make it cost-effective and efficient for investment funds to set up business in Hong Kong. Tax exemption is also provided for onshore private funds, just like offshore funds. First, we introduced the regime for open-ended fund companies, or OFCs, in 2018, and also made enhancements subsequently. The regime provides greater flexibility for open-ended funds to adopt a corporate structure and offers profits exemption. OFCs can enjoy simpler setup procedures and lower administrative costs. Then in 2021, the government launched the OFC grant scheme and the redomiciliation regime for overseas corporate funds. Since then, interest in the OFC fund structure has surged. As of the end of March, both the number of OFCs in Hong Kong and the number of funds set up under the structure more than doubled from a year before. And we have processed 4 private OFC redomiciliation. We expect this impetus to continue. For one thing, OFC are covered in the various mainland Hong Kong Connect schemes. We are now working with the government to optimize the OFC regimes in a few areas, including winding up and anti-money laundering. The second new structure is the Limited Partnership Fund, or the LPF, introduced in 2020. It is favored by private equity funds and has been instrumental to building up Hong Kong as a regional investment fund center. In addition to tax concessions, the framework provides freedom in the scope of investments and flexibility for capital contributions and profit distributions. The feedback on the new MPF structure has been very positive, especially from institutional investors, private equity, and family offices in the Greater China region. As of the end of February, about 600 LPFs were registered in Hong Kong. This year, we're also making a key legislative change in our ongoing efforts to build Hong Kong as an onshore asset management hub. This is the introduction of Type 13 RA activity covering fund depository services. After completing the legislative process, this new RA will take effect in October 2024. Next, I'll talk about Connect as the key platform strategy, which is our second prong of the game plan. As you know, mutual market access between mainland and Hong Kong is our vision and commitment for the long term. The various schemes already in place are pivotal to Hong Kong's status as an asset management hub. Many opportunities are open only to Hong Kong domicile funds, including the mutual recognition of funds, ETF Connect, and Wealth Management Connect. Investors in both markets stand to benefit from both further coupling and product diversification. Our strategy is to expand the sales footprint of Hong Kong domicile funds by building many conduits to reach mainland investors. The first breakthrough was MRF scheme, launched in 2015. As of end March, 37 Hong Kong funds were approved by CSRC for sale to mainland investors, and the cumulative net subscriptions amounted to 14.7 billion RMB. For these Hong Kong funds, MRF channel accounted for nearly half of the overall net subscriptions during the same period. Hong Kong asset managers participating in the scheme can build a brand name and a distribution network for their funds, and this can pave the way for setting up their wholly owned asset managers on the mainland if they decide to do so. While the MRF scheme brings fund products to mainland investors, the Wealth Management Connect brings customers from the Greater Bay Area to the doorsteps of participating banks in Hong Kong. Launched in September 2021, WMC allowed funds to tap into Guangdong province, which has a population 10 times that of Hong Kong and a GDP similar to Italy or Korea. For exchange-traded fund products, ETF Connect builds on the flagship Stock Connect scheme by including funds. ETF Connect was an instant success after its launch a year ago. Even though only 6 Hong Kong ETFs are currently eligible, their daily southbound trading averaged 1.8 billion Hong Kong dollar in April, and this made up about 20% of their average turnover. Of course, for all 3 Connect schemes, we see a need to scale them up, widen the scope of products, and relax restrictions to create more headrooms for fund flows. A lot of plumbing has been done, and we're only waiting for the wind from the east, as the Chinese saying goes. Products is the third prong of our strategy. The SFC aims to enable growth, and we are keenly aware of the need to move with the times and meet investors' evolving demands for different products. Our current efforts center around ESG, virtual assets, and renminbi-denominated products. On the ESG funds, our main focus is on climate-resilient investment products. We aim to help channel capital flows to more sustainable areas of the economy. We also try to reduce greenwashing by ensuring products with a green label mean what they say. Despite the challenging market, it is encouraging to see the number of SFC authorized ESG funds increase more than 50% year on year to 188 as of end March. Their total AUM is up 6% to $150 billion. An immediate priority is to provide guidance to asset managers on how they engage ESG service providers. And later this morning, you will have the panel discussion with Anthony, our colleague, on. In the longer term, we would like to see the development of carbon credit trading, more sustainability-related innovation, and more affordable decarbonization driven by technology. Another key focus is virtual assets products, and later, I think this afternoon, Elizabeth, our head of FinTech, will be participating in your panel. With rising demand for these products in recent years, we have launched initiatives to support responsible innovation and FinTech community. We authorized the first batch of ETFs that invest mainly in virtual assets futures trading on the Chicago Mercantile Exchange. They include the world's first Ether futures ETF and Asia's first Bitcoin futures ETF. And just 2 weeks ago, we released the guidelines for licensed VA platform operators. As with the VA futures ETF, we put in a number of guardrails to protect investors, such as requirements on emission criteria for tokens accessible to retail investors. The development of renminbi-denominated products is an equally important priority. They are essential to the internationalization of renminbi, where Hong Kong plays a big role. Hong Kong has many strengths in this area, and these include our deep renminbi liquidity pool, range of renminbi products and derivatives, and market infrastructure. We will further cement our leadership as an offshore renminbi hub by providing the trading of securities in renminbi and risk management tools like renminbi derivatives. The Stock Exchange of Hong Kong will launch the Hong Kong dollar renminbi dual counter model for stock trading on the 19th of June. More than 20 leading companies will participate, and they account for 40% of daily stock market turnover. Investment funds, ETFs, and REITs are eligible for renminbi counter as well. I can also say we are working with the CSRC to include renminbi counter in the southbound Stock Connect trading. Now, let me move on from products to technology and services, which is the fourth prong of our strategy. When preparing the speech, I've asked generative AI chatbots what investment strategy would work under high interest rate environment. In just seconds, the chatbot suggested short-term bonds, dividend-paying stocks, value stocks, cash and cash equivalents, and diversification. The response is classic, but unremarkable. Also, because the bot isn't licensed with SFC, it actually suggests that I consult an investment consultant. As the AI competition heats up, technologists compare generative AI to the discovery of chips. That is to say, we are on the cusp of another revolution that would change the way we work, live, and play. Some worry it may replace content-creating jobs. If uncontrolled and unregulated, it may even threaten humanity, as it already spreads fake news and images. On one level, AI and machine learning are nothing new in the financial services space. Asset managers have used AI to construct portfolios, generate big data analytics, perform risk management, and increasingly communicate with our clients. As an information aggregator, AI can outperform any human brain in speed, but its output merely averages past experience and deals with maybe known unknowns. Clearly, this makes human brain more valuable when it comes to strategic decision-making and dealing with unknown unknowns. Every one of us must learn how to work and live with AI. AI is fast gaining traction and will soon proliferate around us as it streamlines the routine work of financial advisory, portfolio construction, big data processing. It will free up time and capacity for asset managers to better strategize and perform. More generally, technology and digital tools must be leveraged further to improve, in particular, our clearing and settlement processes. In this area, SFC embraces technology and is open to the idea of fund tokenization going forward. I believe generative AI can be used responsibly to augment rather than replace asset managers in strategic decision-making. As a regulator, the SFC is guided by our philosophy to promote responsible deployment of technology that enhances market efficacy and transparency, cost savings, and investor experience. However, at this stage, firms must take that technology with a grain of salt. Stay alert to AI-related risks and make sure that clients are treated fairly. We expect licensed corporations to thoroughly test AI to address any potential issues before deployment and ensure the quality of data used by the AI. Firms should also have qualified staff managing their AI tools, proper senior management oversight, and a robust governance framework for AI applications. For any conduct breaches, the SFC is not going to arrest an AI. We are going to look to hold the licensed firm responsible. So in closing, I'll circle back to what I said earlier about the need to balance defense with offense. I've shared SFC's four-pronged strategy: onshoring of investment funds, building more conduits to enhance the sales footprint, the diversify the investment product offerings and embrace technology and to enhance the financial services returns. I trust you have made your own game plan, so please keep your eye on the ball and seize the chances to score when they arise. Ladies and gentlemen, we have reflected, reset, and refocused our strategy. I wish I can say that you can relax, rejoice, and in anticipation of a rebound of your revenue. But unfortunately, the road to recovery remains very bumpy with the economic headwinds and headline risks. So that requires all of us to stay vigilant and to use my favorite word, which I said in every speech: stay resilient. Thank you.